Hi everyone, and welcome to this new edition of the Doing Ecological Economics seminar, today devoted to the topic of ecological economics and monetary policy. First of all, thanks of all to all of you who tried to attend last week. We had some technical issues, so we had to postpone to today. So welcome again. We are very happy that you're here. So just a brief reminder, the aim of the Doing Ecological Economics seminar is to share experiences and discuss the reach and influence or lack of influence of ecological economics in society and ways to improve it. And we've tackled a number of topics already. You can see the previous seminars on the channel, the YouTube channel of the International Society for Ecological Economics. And therefore, today we will discuss quite a hot topic, which is monetary policy, the monetary system, and environmental issues. So I have two guests with me today, Katie Kedwards, who is a policy fellow at the Institute for Innovation and Public Purpose at University College London. Hi, Katie. Thank you very much for being here. And David Barmes, who is head of research at Positive Money UK. Hey, David, thanks as well for being here with us today. And in the background, you don't see her, but there is Paola Novo, who is a lecturer in ecological economics at the University of Leeds, and who takes care of the StreamYard studios. So welcome, everyone. So maybe just to start and to spur the discussion, Katie and David, you can introduce yourself a bit more. Tell us what is your background and what is exactly that you're working on at the moment. Katie, you want to go first?
Sure, I can go first. Thank you very much for inviting me, Louison, to this seminar. Looking forward to the discussion and answering everyone's questions. So to introduce myself, I am Katie Kedwards, a policy fellow at UCL IIPP. I started my career in the financial sector on a graduate programme. But quickly transitioned into working on green finance issues by working at the NGO Share Action, which is a UK NGO that campaigns for a responsible investment system. I then went back to school and got a graduate degree in ecological economics. And since then, I've been working almost exclusively on green finance issues at UCL. My work very much is focused on the role of financial policymakers in accelerating and steering the green transition in the financial sector. And in recent years, I've extended this work from climate to also look at biodiversity and biodiversity finance, what the role of central banks should be there, and also the role of these kind of new asset classes for nature, which are cropping up more recently in the discourse. And finally, I also do a lot of work on the macroeconomic dimensions of the green transition. So stuff like the Green New Deal, green industrial policy, and more broader macroeconomic issues like that. That's me.
Great. That sounds like a perfect mix for today's seminar, actually. Thanks a lot, Katie. David?
Yeah, thanks, Louison. So I've been an economist at Positive Money for about 3.5 years, and I've recently moved into a head of research role. Before that, I studied the Socio-Ecological Economics and Policy Masters at the Vienna University of Economics and Business. And before that, I was studying economics at McGill University, where I kind of first started exploring ecological economics and monetary issues. And had some really fruitful interactions with some graduate students and professors over there and in Vermont. For anybody that doesn't know who Positive Money is, and what we do, we are a research and campaign organization working towards a money and banking system that enables a fair, sustainable, and democratic economy. So we produce research, we influence policy, and we run campaigns on a range of topics, including green central banking and financial regulation, central bank digital currency, and housing affordability. I've so far focused mostly on all of our environment-related work, but have more recently been branching out to some other topics as well. And just in terms of things coming up on Positive Money's agenda, we've got an update to our Green Central Banking Scorecard that we're publishing in a couple of weeks. And we've also got our first Positive Money US report that will be coming out towards the end of the year, and that will be on inflation and fossil fuels and environmental breakdown.
Well, that sounds quite interesting. Thanks a lot, David. Just before we move on with further questions, I just want to tell everyone who is now attending the seminar that you're very welcome to post your question in the chat, so that we can relay them to Katie and David, and that will also fuel the discussion today. So please don't be shy. This is meant to be a conversation, so please post your questions and remarks in the chat. So just to jump in a bit on what you both said, so you both have quite a unique profile, because you have as I understand it, you have a background both in ecological economics and in monetary economics or finance, which is not a very widespread profile yet. So how did you come to environmental issues with your background in money and finance, or how did you come to money and finance with your background in ecological economics, depending on the order that corresponds to your trajectory? Katie?
Yeah, that's a good question. Well, I guess, I mean, starting at the beginning of my career, when I actually worked in finance, I didn't have any interaction with environmental issues at all, which was part of the frustration I sort of felt in that role. I was working on the trading floor of a global investment bank, trading government bonds and also derivatives, interest rate derivatives. And one of the things I sort of observed as a graduate on that graduate program was that, you know, there were environmental things happening all over the world which were affecting governments, government debt and government cost of borrowing, but this wasn't really being addressed or kind of even accounted for in how people in that career were kind of looking at these issues. And that's partly why I wanted to kind of go back to school and try and understand the interconnections between not just finance and the environment, but how finance is embedded in society, which is embedded in the environment, and the kind of interactions between them. So when I was working for Share Action, the NGO that campaigns for a more responsible investment system, this was sort of my first introduction into green finance, I guess. And the theory of change that operated when I worked there was that we need to hold financial actors to account. You know, there's so many investors out there, banks, insurers, asset managers, pension funds, making these bold or, you know, seemingly bold commitments on climate. Are they actually following through on them? What are they doing? What is the progress they're making on this? How is this actually looking in terms of capital allocation? And, you know, when I sort of spoke to these investors and spoke to banks on the inside to sort of understand the ESG or corporate social responsibility initiatives they had, what I kind of found was actually, you know, these actors, however good willing they may be, and that is also open to question, right? But, you know, however willing these kind of sustainability finance people were, they were encountering a huge amount of uncertainty on how to implement the, you know, sheer plethora of voluntary private sector-led initiatives on green finance there are. And there was this huge diversity, and there still is a huge diversity of approaches emerging on how to measure and report climate financial risk, biodiversity financial risk, and other environmental problems. And that's even before we start talking about greenwashing, right? So kind of what I was observing was like, you know, the private sector leading on these approaches is not actually setting a direction which is creating certainty for the private sector as a whole. And there was perhaps a greater role for policymakers or financial regulators to come in and kind of steer the way in order to accelerate progress, because progress, frankly, wasn't and still is not happening at the pace we need it to for rapid transformation, rapid decarbonisation. So, and that brings me to my current work at UCL, where we're very much targeting central banks as the chief financial policymakers in many economies today. And it's probably worth actually defining what central banks actually are, in case, you know, you don't know, and there's no reason why you should know, because well, they don't exactly promote their purpose necessarily as well as they should do. But just to quickly define what a central bank is, it's the public financial institution in most economies which sets interest rates for each country, which basically sets the cost of borrowing. So, the power to set interest rates obviously has repercussions on how much economic activity takes place, where economic activity takes place across the economy. And central banks also have a really important role in regulating the financial system. So protecting consumers, protecting the system as a whole from, destabilizing crises like we saw in 2008. So the important thing is they're really powerful public authorities that have a huge amount of potential influence in helping to accelerate the reallocation of capital, which, of course, as we know, finance is a strategic leverage point for this kind of structural transformation we need to see. And so our current work is very much targeting central banks and what they could do to accelerate this transition.
Thanks a lot, Katie. Yes, we will have a chance to discuss a bit more central banks and what central bankers do in a minute. But before developing a bit more on that, David, do you want to explain a bit how you came to work on those topics at the intersection of those topics?
Yeah, sure. So it started actually back in school, in high school. I kind of stumbled upon a documentary called 97% Owned. I was watching a lot of documentaries at the time, and came across this documentary that was all about how commercial banks create money, essentially. And as I think often happens with people exploring this topic, it can be kind of mind-blowing. And so I was fascinated by that, and actually Positive Money played a role in putting that documentary together. I think my colleagues wouldn't necessarily subscribe to everything that's in there now, but just that kind of introduction into some basics of how the monetary system works, that was really gripping for me. And so then when I went to university, I decided I wanted to study economics. I thought that we would be addressing some of those issues in an economics degree, and talking about the financial crisis, sort of real world issues. And at that time, I was becoming more politically aware and more environmentally aware. So ecological issues were also very much on my radar, and the ecological crisis being one of the biggest issues that we face. And then as I was studying the economics degree at McGill, I found that essentially none of that was being addressed, neither in the economics department nor in even some of the political economy courses I was taking. So with that kind of disappointment and disillusionment, there was a big desire, a hunger to kind of find people and groups that were looking into some of these issues. And luckily enough, there was a graduate program called Economics for the Anthropocene. That was a collaboration between McGill and University of Vermont and the University of York, I believe. And so I got in touch with some of the professors and students on that program. And that's kind of how I really got further stuck into the intersection of these issues. And there was one professor in the economics department that was also interested in this and taught a course on this. So yeah, that was kind of my introduction. And then, I kind of sought intellectual refuge, I guess, with that group of people, and just devoted much of my study time towards developing my knowledge in this space, doing independent research courses. And then, I continued on that trajectory with my master's. And then it kind of felt like things came full circle when Positive Money had an opportunity to join the team as an economist. And so it was kind of my dream job, addressing all of the things that I had just been studying for 5 or 6, maybe even 7 years or so.
So to jump in a bit more on your own experience, and before developing a bit more on central banks and policymakers, Katie, you were explaining that you started by working in finance, and by the time you did not have any contact with the topic of environmental issues. However, could you describe a bit whether the people working in this environment had any interest in the issues themselves, or whether it was like completely essentially outside of the picture?
Oh, people definitely had an interest in environmental issues. In that, most people, believe climate change was a real thing, and this is also the case with the people I worked with in the financial sector. I think the issue was that they didn't see it as being integral to their particular job. And I think we see this quite a lot in specific areas of how finance operates, in that the kind of way the way people work within, say, something like capital markets, are you working on a trading floor, is a very kind of siloed approach to thinking about issues. So I worked on a desk of like really, really smart, switched on, engaged people, but they only traded government bonds and derivatives, right? They didn't necessarily kind of think about the bigger picture. And you could say that about a lot of different aspects of banking. It's a very kind of siloed way of thinking about issues. I believe that has definitely changed in recent years. So it's kind of, goodness, how long is it now? Like 7 years now, 8 years since I worked in finance. And, climate change over that time has become very much more present in our lives. And, we're seeing events happening today, such as in Pakistan, huge flooding, which are very much impacting on financial instruments in real term. And I think, the kind of attitudes I faced back then, I would imagine have shifted now. But there is still a tendency amongst some financial institutions, people who work within certain financial institutions, to culturally still see environmental issues as separate, this kind of ESG category, a green label. We have these green labeled bonds, which, everyone, there's a huge fanfare around, rather than seeing it as something which should encompass everything, every way we kind of look at society, every way we look at our productive activities in the economy. The kind of embedded worldview that ecological economics has is not necessarily the mainstream yet, even if the attitudes are changing.
All right, thanks a lot. Yeah, let's hope that the attitudes are changing. So now to move a bit more towards the core of this seminar, which is entitled like a policy view. Could you tell us briefly, like, what is your general experience working with policymakers? Did you have the chance to have exchange with policymakers? And if any, what is your impression about their own perception about monetary policymakers, their own perception about environmental issues? David?
Sure, yeah. So I interact with policymakers in a couple different capacities, which sometimes overlap. So first of all, interactions with policymakers are part of certain aspects of my research. So for example, as I mentioned earlier, we publish a G20 Green Central Banking Scorecard, which I believe remains the only green sort of ranking of monetary and prudential authorities. And as part of that research process for that project, we reach out to every institution we assess, and we have exchanges, both written and verbal, with central bankers responsible for climate and sustainability within their institutions. Secondly, we also have a team at Positive Money that is specifically devoted to media outreach and policy influencing. And so I collaborate with that team in their influencing activities, briefing policymakers, preparing press releases, responding to consultations, and so on and so forth. In terms of how policymakers are perceiving environmental issues, I think there's probably a bit of a difference between monetary policymakers and financial policymakers here. I guess maybe the term financial policymakers is often used quite broadly. Let's say between monetary and prudential policymakers. I think monetary policymakers have been viewing environmental issues as very much beyond their scope, at best an area for research and something that could potentially affect the context in which they operate, but not so much something for them to influence. There are a few central banks, especially in the global south, that have a bit more of a history of taking a more proactive role in shaping financial markets in line with environmental goals. But in the global north, monetary policymakers have only really, in the past few years, I think, started to recognize that they have a role to play and have started implementing certain climate-related policies. I think climate change came onto the radar of prudential policymakers a bit earlier, as there's been a growing recognition that climate change poses material financial risks, and therefore prudential policymakers have a responsibility to understand and manage those risks in line with their financial stability mandates. And this is now starting to happen with other types of environmental risks, such as risks related to biodiversity loss, which is something that Katie works quite a lot on. But overall, I think all of this has been a relatively slow process for policymakers, and of course, there's a lot more work to be done to achieve both monetary and more broadly financial policy that is aligned with an ecological transformation of the economy.
Thanks, David. Katie, is your impression in line with David, or?
Yeah, definitely in line. I think it's worth also adding that there are some monetary policymakers, some central bankers out there who still resolutely believe that climate change and other environmental issues are not their problem at all. They think governments should lead on the green transition and central banks should stay out of it as much as possible. I'm sure we'll come on to those kind of attitudes later on. In terms of how they're perceiving environmental issues, coming back down to the kind of economics theory side of things, they're very much, by and large, taking this neoclassical economics view of understanding environmental problems as negative externalities that need to be fixed. So this conceptualization, which has been developed over the past few years of climate-related financial risk and biodiversity-related financial risk, is, considering basically how these externalities need to be accounted for in monetary terms in financial decision-making in order to shift capital allocation. So it's a market-fixing strategy. And there are a number of issues with this, really. First of all, by presenting environmental problems as purely an information problem, you're sort of assuming that these issues, all environmental information is knowable and measurable, and subject to sufficient enough certainty that financial institutions will be able to bang a couple of climate factors into a model, run the model, and then make their decisions based on the outputs. And we see this in the sorts of policy solutions that are being promoted by central banks and financial regulators. There's a big push for environmental disclosures, so where all corporations, not just financial institutions, disclose their exposures and their risks. We'd have this concept of physical risks, which is exposures to climate damages, and also transition risks, which is exposure to activities which might be subject to more regulation or changes in consumer behaviour in the future. And then there's another push for a policy tool known as scenario analysis, which is, like I mentioned, basically running models on the basis of the information disclosed in these disclosure frameworks. And that is very much the overwhelming focus, I would say, of how central banks are approaching these issues. I'll come on to it in a bit more detail later on, perhaps, but as central banks have expanded their bandwidth to think about not just climate change, but also biodiversity and nature loss and broader environmental problems, this kind of theory of change is slowly but surely being called into question, not least because the idea of quantifying biodiversity defies even scientific experts or the ecologists, let alone a central bank or a financial institution.
Yeah, that's interesting. Just before we move further on this, you mentioned that some central bankers, some monetary policymakers still believe that climate or environmental issues at large are not their problem. Do you have an idea why this is still their state of mind today?
Yeah, I think as a bit of context, it's worth bearing in mind here that central banks in most high-income economies and an increasing number of low-income and emerging market economies maintain this strict operational independence between central banks and other parts of government. This is a kind of actually historically fairly recent development. Before the 1980s, central banks and governments routinely coordinated in how they applied monetary policy. But I mention this context because I feel that amongst those central bankers who are resolutely against central banks actually taking action on climate change, even if they do, care about climate change on a personal level, it's because they're very sensitive to so-called political topics which threaten their mandates, threaten their operational independence. And, we see this discourse on the kind of more right-leaning media, right-leaning discourses, which are have been criticizing central banks for even deigning to talk about climate change. So, they're kind of they're trying to manage this kind of political environment. And, thinking about the political economy of a central bank, operational independence grants central bankers a huge degree of power and autonomy, right? So it's very difficult from this kind of political economy perspective for an institution to push against the very remit that gives it this authority. And I think this is why we see central banks kind of tiptoeing quite carefully around the climate issue, and where they are recognizing it, overwhelmingly recognizing it in terms of how it is first and foremost affecting their primary mandates of protecting price stability and financial stability, as David said.
So just before we move further, some of the people attending the seminar right now may wonder why we did not invite some monetary policy makers or some central bankers today. Actually, we did try, but it's very hard for them to take part in a public seminar like the one we have today. They are not really allowed to talk or to talk freely as members of central banks. They have to obey certain rules. So that's why we could not have with us today some people directly involved in central banks, but we would have loved to. Just to elaborate a bit on this before moving further. So in 2015, I hope I'm not mistaking the date, there was this famous speech by Mark Carney about the tragedy of the horizon, right? And since then, there has been also quite strong declaration, for instance, by Christine Lagarde, the governor of the European Central Bank. There has been the creation of the NGFS, which is like the network on greening the financial system, which is a network of central banks, of people from many central banks working on those issues. And very recently, a few days ago, the vice governor of the Bank of France, Sylvie Goulard, had quite strong words, at least by the central bankers' social norm scale, so to say, because she said that she asked in a speech, she asked how much we can still grow to make sure to stay within the planetary boundaries. Then she asked the following question: how to make sure that we distribute the remaining growth potential, that's her words, between rich and poor countries. And the idea of a remaining growth potential is implicitly acknowledging the finiteness of growth, which is a very strong statement for a central banker. And she also makes an interesting point in her speech. She says that some people, just like you mentioned, Katie, some people might think that those topics are too political for central banks. But she adds it would be even more political to deliberately ignore the overwhelming amount of scientific evidence on the ecological situation, and therefore it will be even more political for central banks not to deal with those issues. So when we look at all those steps since Carney's inaugural speech, so to say, we might have the impression that those issues are becoming pervasive in central banks. But do you think that's really the case, or is it is it really like widespreading, so to say, in central banks, or is it remaining rather marginal so far? David?
Yeah, it's a good question. Yeah, I think first of all, I would maybe just challenge some of the framing of the question in that I think Mark Carney, he gets a lot of credit in this space, and I'm not sure I would consider his speech to be like the inaugural speech with all of this. There were some central banks that were doing work on climate before that speech, and I'm thinking in particular, when we studied G20 central banks, we found that the Brazilian central bank and the People's Bank of China in particular, had implemented green policies, albeit not necessarily very powerful ones, but they were doing some work on this quite a while before Mark Carney got involved. But yes, I think his speech was like somewhat groundbreaking certainly for a lot of central banks in the global north. And yeah, I think now, there has been a lot of, let's say, progress in terms of these issues becoming more widespread. If we just look at the membership of the Network for Greening the Financial System, it started 5 years ago with just 8 founding members, and today it has 121 members. I don't think that's necessarily like a great measure of progress, but it shows that there has been at least some evolution in central bankers' perception of these issues. And I think also how they want to be perceived. I think they do care about their reputation, and as environmental issues have really climbed up the public, the political agenda, they do want to make sure that they have some things to say, some work that they can show when they're asked about this kind of thing. In terms of Sylvie Goulard's speech, I think that was very bold for a central banker. I think there was also the Bank for International Settlements and French Central Bank book, The Green Swan, that was published in 2020, which has been like, I think central bankers have referred to this book really widely, but one part of it that they tend to ignore is actually the part that refers to strong sustainability and limits to growth, and references many ecological economists, and even has the classic diagram of the economy embedded within society and within the environment. So it's quite interesting that that book / report was, I think, has been very influential, but that chapter, those few pages, don't get discussed very much. So it was, I think, really welcome to see Sylvie Goulard picking up some of those themes. I think even more surprisingly, Kevin Styro, who leads the Federal Reserve's Supervision Climate Committee, authored a Federal Reserve paper acknowledging the relevance of double materiality for macroprudential frameworks. So double materiality involves looking at how financial institutions contribute to environmental breakdown and the risks that come with that, and not just how they're affected by it. So yeah, I think there has been an evolution in perceptions. Just also one point, especially while I'm on the Fed, I think it is important to note that, like, also coming back to Katie's points on operational independence, one of the key ways in which central banks are very much not independent is that senior positions tend to be appointed by elected officials, tend to be appointed by government. And so in the US, there was a really interesting kind of fight over the vice chair for supervision role on the Federal Reserve Board, where Biden nominated Sarah Bloom Raskin, who was known to be quite strong on climate. And precisely for that reason, she did not get that position. It didn't pass the board of I think it's Congress people that have to confirm that nomination. And so all the Republicans on that board refused to confirm Sarah Bloom Raskin's nomination to that position, and it was very much on climate grounds, and they also all happened to have ties with the fossil fuel industry. So this is one of the ways in which this stuff is incredibly political, and I think those types of senior positions can really have a big impact on the culture and the approach to climate change and environmental breakdown at central banks, in the same way that Sylvie Goulard may be having an impact on the culture at the French Central Bank, being a very senior official, a deputy governor at the French Central Bank. It's quite exciting to see some of these arguments coming from her.
Yeah, it is. Of course, one could also argue that what also matters is the composition of monetary policy committees, for instance, and the composition of the various boards in central banks. And the composition of these boards could also be discussed, because some central banks include a variety of representatives from different areas of society or different regions. That's the case of the Fed in the US or the Central Bank of Australia, for instance. But to the best of my knowledge, it is not the case, for instance, of the ECB. And people could contend that, for instance, representatives of labor unions or environmental NGOs could legitimately be represented in those monetary policy committees, and not only people, for instance, from the financial industry. So because that, of course, shape as well the rationality of the central bank in the way it deals and interpret the information that comes from the payment system that central bank oversees. All right, but to dig a bit deeper on the topic, Katie, you were pointing towards the kind of analytical approach or theoretical approach that central bankers have in mind when approaching environmental issues that remain very neoclassical, very negative externality framed, so to say. And so could you maybe both of you try to elaborate a bit more on how do you think ecological economics could inform central banking when it comes to dealing with environmental issues? Katie?
Yeah, that's I can start with that one. Well, I think there needs to be a lot more recognition of the system complexity that we're talking about when we refer to not just looking at ecological problems in isolation, but the kind of metabolic links between our real productive activities, how they draw from nature, how they kind of spew out pollutants into nature and impact upon it, and then also the metabolic links from the economy into the financial system, and how all of those kind of different levels interact with each other. That, thinking of it in system terms, is highly complex and arguably unmeasurable. So for policymakers, the next question that's posed is, how do you make effective policy decisions under a situation of fundamental uncertainty? Especially given the fact that the environmental breakdown, the trends that we're seeing at the moment, are completely historically unprecedented, and there are no meaningful probabilities you can attach to potential future outcomes, which is how conventional financial risk models, they kind of rely on those probabilities, right? So thinking about acting under uncertainty, I think, is a major contribution that ecological economics can provide. I'll hand over to David to build on that.
David, do you want to build on that?
Yeah, sure. Yeah, I mean, I think there's a related question here. I think it's not just about what central bankers can learn from ecological economics, but also what those in governments setting central bank mandates might also be able to learn from ecological economics, because I think the whole setup that Katie outlined earlier regarding operational independence and these very narrow mandates of price stability and occasionally financial stability. Occasionally there's one or two other things in there, like unemployment in the Federal Reserve's case, but generally it's pretty narrowly focused on price and financial stability. I think that setup and this very siloed approach to monetary policy, financial policy, and that being separate to fiscal and environmental and industrial policy. I think that's really just not aligned with ecological economics, it just fundamentally. And so I think reassessing that whole regime and the mandates that we give to central bankers and financial policymakers more widely, could be much better informed by a real understanding of ecological limits and the urgency of the transformation that we need. I think I'll probably leave it there for now.
But that's so those are interesting points, because something that central bankers are afraid of, and a reason they often raise to say, okay, we should not necessarily be dealing with environmental issues, is this idea of a conflict of objectives. So their mandate is primarily to deal with price stability, so to ensure essentially that there is no inflation, or no inflation above 2%, for instance. And they say that they cannot do all the things at the same time. They have a limited set of instruments, so they should abide by what their mandate tells them to do first, and that may involve trade-offs with other objectives. And I have to admit that to me it's quite striking what we're observing now, because so we recalled a few minutes ago, like this kind of evolution in what we could label like the ecological turn in central banking since a few years, and still the post COVID inflation, the reaction of central banks to post COVID inflation shows like a kind of a stark contrast between those declarations and what central banks are actually doing, because the interest rate hikes may very much potentially impede, for instance, on the investment necessary to carry on the low carbon transition. So here it looks a bit like there is a conflict of objective arising not so much from the nature of the phenomena at stakes, inflation on the one side and the low carbon transition on the other side, but that a conflict of objective that is entirely made up by the framework, the operational framework of central banks. So we have a question in the chat from Andrea asking to what extent central bank interest rates really do influence private banks' interest rates. And if it does, what do you think central bank should be doing, or government should be doing regarding central bank mandate to avoid this kind of artificial trade-offs, artificial conflict of objective?
I can start with that one. I think both of these questions are very topical. I think, as you kind of allude to, Louison, there's a false dichotomy being presented here, isn't there? By, we have to solve inflation first and foremost on the one hand, and versus on the other hand, whilst we're doing that, we can't possibly also adhere to all of these kind of like green climate related considerations. I think this is a false dichotomy. And to give an example of how this has been presented recently, Isabel Schnabel, who is one of the governors of the European Central Bank, the ECB, she gave a speech a couple of months ago where she sort of alluded to the fact that climate change policies may have contributed to the current inflationary dynamics. And she used this label greenflation, which sparked a huge kind of reaction from environmental campaigners. Because, of course, the inflation that we're seeing at the moment, aside from the fact that it's very much been sparked by the geopolitical tensions from the Russia-Ukraine war, is actually a symptom of the fact that our entire social provisioning systems are dependent on fossil fuels. The fact remains is that if governments had been successful in accelerating decarbonisation 10 years ago, households, small businesses, firms, the entire economy would not be as dependent on volatile increases in fossil fuel prices that we're seeing today. So, rather than talking about greenflation, we really should be talking about fossilflation. And coming on to Andrea's question, to what extent if I kind of interpreted correctly, it's to what extent do central bank interest rate changes affect the whole economy? The answer is a lot. The base rate that they set banks basically apply a markup to that base rate in how they set loans, loans for mortgages, loans for businesses. And it also affects the cost of government borrowing as well to a certain extent. So, bringing that back to this inflationary crisis, what could central banks do? What could monetary policymakers do to kind of tackle inflation whilst not undermining the progress that we need to make on the green transition? There's some proposals out there that central banks should actually set two interest rates. So one general interest rate for the whole economy, and then a much lower interest rate, which is designed to support green innovation, green transition related activities, so that they can still take place. Businesses can still invest to decarbonise despite higher interest rates across the whole economy. And the argument here is that by tackling fossil fuel dependency in the system, you're tackling reliance on volatile fossil fuel prices, which underpin inflation, and thereby it's a long-term strategy for bringing inflationary exposures to fossil fuel prices down in the long run.
And just before we go on, David, I think it's worth mentioning that this kind of proposal differentiated target interest rate, for instance. They are not only abstract proposal in the academic literature, but they actually have been implemented already by a number of central banks in low and middle income countries. Maybe David, you can a bit elaborate on that just after. So it's really something that is already done and that is perfectly feasible also by global north core countries central bank. And just to finish to reply to Andrea's question, Andreas is based in Denmark, as she signaled, and I am also based in Denmark, and we could also see immediately in the past weeks, as soon as the Danish central bank raised their target interest rate, within days, Danish central banks actually also changed their interest rate. I received an email from my own bank, so we could see directly the interest rate channel at play between the central and the commercial banks here. David?
Yeah. So yeah, on the green lending facilities that you mentioned, Katie, and that you raise as well, Louison. Yeah, absolutely right. This is something that is already happening. Most recently, both China and Japan implemented schemes exactly, following that model. There are still major issues with these schemes. Most importantly, the way in which the term green is being used, or what is defined as an activity that contributes to climate change mitigation or the green transition. There are still some big issues around that, and there's, I think, a bit of a danger that some of these tools, unless we get those definitions right, that some of these tools could be used to support activities that actually have a harmful impact, environmental impact. But yeah, it is, these central banks have shown that these policies can be implemented. And of course, the ECB has, Christine Lagarde has spoken somewhat in favor of this idea. And my colleagues at Positive Money EU have been doing a lot of work on that particular policy recommendation. On the broader point here on inflation, while I think Katie's absolutely right on the effect of interest rates across the economy, I think we also need to again come back to this question of the macroeconomic framework and recognize that central banks should not actually have sole responsibility for managing inflation. Even if we give them some more tools that affect the supply side of the economy a bit more and can support the green transition, there needs to be a much more coordinated, coherent, progressive approach to inflation control. And that goes well beyond central banks. Interest rates are a very blunt demand side tool. And when inflation is, as it currently is, coming from, quite specific supply side issues, it's a tool that really doesn't make much sense, and it actually causes a lot of damage and pain for ordinary people. The whole way in which interest rate hikes are meant to work is essentially by making people less well off and increasing unemployment. So very blunt tool, serious negative repercussions, and doesn't address the specific supply side factors like volatile fossil fuel prices, like shipping disruptions, and also corporate profiteering, which of course is something that central banks have not really been talking much about in this inflationary crisis we've seen. So I think we really need to move away from relying on monetary policy to manage demand and to manage inflation, and we need a much more coordinated approach that involves a wider range of authorities, including government authorities like fiscal and industrial and environmental authorities.
Yeah, so what are you explaining, David, is what a lot of non-mainstream economists have been saying for years, that first of all, it's not obvious at all that the mandate of central bank should be about controlling price stability. This only makes sense if we consider that inflation is actually a monetary phenomenon, but that can be very much discussed. For instance, if we agree that the supply of money, that the quantity of money in circulation in the economy is determined endogenously by the demand for money from the economic agent, households, firms, even states, then if we draw all the logical conclusion from it, it's not clear at all that the central bank is the relevant institution to deal with inflation in the first place. And also, if we agree that inflation is a much more complex phenomena than just an issue of the money supply as compared to the volume of good and services in circulation in the economy, it requires much broader policies that also involve fiscal policy, industrial policy, and why not environmental policies as well. Yes, on these issues, I think it also reflects the retreat of government from economic policies, at least in high-income countries, because it's been quite striking to see the rise of central banks since 2008, essentially. Not that central banks were not important before, of course they were, but there was like a huge rise in the importance of central banks since 2008, and this is reflected by the balance sheets of central banks. Central bank balance sheets have grown enormously in the past 10 to 15 years, essentially. Okay, so for instance, we have like 8 minutes left, so maybe I could ask you, if you were to be appointed as prominent central bankers tomorrow, what would be like the 2 or 3 measures that you would take to deal with environmental issues? Yeah, that's an easy one, right?
Well, I think it's hard to pick 2 or 3. I think that's the challenge. Well, we haven't spoken. We've already spoken about green monetary policy, so I won't go into that again, although that's definitely on the list. We haven't spoken so much about financial regulation actually yet, but I think it's hugely important. So up there on the list for me would be some form of green credit guidance policy. So credit guidance basically describes interventions taken by financial authorities to set the price or quantity of credit and where it's directed in an economy. There's actually a very long history of credit guidance being used in both high-income economies and also low and middle-income economies, throughout the 20th and 21st centuries. But it's fallen out of fashion, so to speak, under the current kind of operational independence of central banks that's currently favoured. So what would green credit guide? What is the rationale for it? Well, I mean, firstly, the rationale is to create certainty for the private sector in where they're directing credit, and where they should direct innovative activities to. Like I mentioned earlier, there's a huge amount of uncertainty being created by the plethora of voluntary private sector initiatives, a lot of which conflict with each other, and also there are fundamental conflicts of interests with for-profit for-profit actors designing their own kind of regulatory systems, right? So this is kind of the rationale for there being much more democratic public oversight into how green credit is kind of defined and steered, so as to accelerate the kind of the structural economic transition, which we need to happen very rapidly now. So what would this look like? Well, first of all, there's argument for this sort of regulation to focus on defining what should be deemed green. There have been efforts to do this with the European Union's taxonomy, which unfortunately has also been plagued by its proximity to vested interests. But in theory, at least, kind of a well-designed kind of public taxonomy with good democratic oversight can really help kind of galvanize financial investment towards green activities, and help that by, for example, setting minimum quantities of energy efficient mortgages that banks have to provide. It could stipulate that banks provide retrofitting loans at very low interest rates, or even zero interest rates for certain kinds of low income households. And all of these things will be needed to kind of help with the very large upfront costs of some aspects of the green transition. But not only the green side is important, obviously, we also need to avoid harmful lock-in effects, which result from continued flows. At the moment, there are huge flows of finance that still go to the exploration and production of fossil fuels, the persistence of highly unsustainable forms of industrial agriculture, mining, all of the other kind of primary production industries, which need a huge amount of green innovation, essentially, to kind of bring them in balance with nature and with the requirements of decarbonisation. So these sorts of financial regulations could make interest rates very, very high for bank lending to these sectors. They could set very punitive capital requirements, which basically ask banks to set aside a large portion of their profits against these loans to kind of disincentivize them. Or these regulations could even just outright ban the very worst forms of activity, which are obviously incompatible with a green transition. And finally, we've not talked about them much in this session, but regulating shadow banks, I think, is important. So shadow banking basically refers to a banking activity, so lending, financing, which takes place outside of the regulated banking sector by entities like private equity actors, hedge funds, money market funds. And this is important because where banks are doing the right thing and divesting from oil and gas assets, or other kind of activities which are in conflict with their climate commitments, we're seeing these other actors, shadow banks, sweep in to hoover up these assets and continue to benefit from the ongoing profitable opportunities that there are there. And this very much needs to be taken into account. And that leads to my second point, my second policy, which I think we see a lot more of. And this comes back to what you were saying, Louison, and David, about thinking about coordination amongst different policy actors more broadly, not just central banks in silos. I think we need to see a lot more public investment for the green transition. At the moment, we have this huge over-reliance on private sector finance, and we forget that governments also have huge investment capacity, more so in the global north and the global south, due to kind of structural inequalities. But where governments are able, they should be using their public financial institutions to invest substantially for the green transition. And where they've done this, in localities where public green investment capacity has been deployed, green innovation, such as in offshore wind, solar, has actually been accelerated. Public investment has this crowding in effect. It doesn't crowd out private investment like neoclassical economics likes to predict. So it has the opposite effect. So this is another pathway of creating certainty. And coming back to what I was saying about shadow banks, one role for public investment could be to actually buy up legacy oil and gas assets, for example, and recoup those kind of last few dying days of profits and kind of recycle it back into the green transition effort.
Thank you, Katie. David, you have exactly 19 seconds left to say what you would do. So maybe if you had to pick one measure.
Okay, yeah, sure. I mean, Katie covered a lot of great ones anyway. I think maybe just a bit outside the box. I would try to bring a climate justice lens to some of the discussions happening in central banks. Now, there are a few concrete policies, I guess, that could come from this, but I think this is just in general something that has been completely absent from green central banking discussions, a recognition that the impacts of global warming and environmental breakdown are not borne equally and intersect with a number of structural global inequalities relating to race, wealth, and gender. And the poorest communities in the global south are disproportionately facing the impacts of environmental breakdown, yet bear by far the least responsibility. And I think, bringing some discussion around the historical responsibility for these issues, and central banks are part of that history. They have underpinned colonial expansion. They have, really played a role historically in environmental breakdown and all sorts of social harms. So I think that's something that, should be brought into green central banking discussions in high income countries. So I'd maybe prioritize that as my one not so much a policy, but one thought on what I would do on my first day as a senior central banker.
Well, that's a lot of ideas and policies to build upon. Thank you very much to you too. We had a final question in the chat, still by Andrea, about this interest rate transmission, and Andrea asked if the influence on private bank interest rates isn't a more cultural convention rather than a technical influence. And we don't have time to delve into the technicalities of interest rate setting by the central bank, but what can be said is that it's actually more than just cultural convention, because there is a corridor of interest rate that is set by the central bank, and there is the floor rate on central bank, on commercial banks' reserves at the central bank, and there is a ceiling rate at which banks can borrow from the central bank, and this will determine the rate on the interbank market at which commercial banks borrow the liquidities they need. So if commercial banks want to access liquidities at a reasonable rate, they have to abide by the interest rate set by the central bank. So it's more than a cultural convention. It also very much impacts on the profitability of commercial banks, and negative interest rates has been a huge challenge for the profitability of commercial banks during COVID. So it goes beyond and deeper than just a cultural convention. It is to a large extent a technical influence. It's more than an influence. It's actually a control that the central bank has on commercial banks' rate of interest to a large extent. All right. Well, we could go on for ages, actually, because there are still a lot of things to be said. But if everyone is interested, you can Google the name of everyone involved in this seminar, and you will find interesting stuff to read. Thanks a lot, David and Katie, for being with us today. And everyone stay posted, because more Doing Ecological Economics seminar will come soon. Thanks a lot, and see you soon. Bye-bye.
Thank you. Bye-bye.
Thanks very much. Bye.